But let me also bring on board, Sanjay Agarwal, who's the senior director and head BFSI at Care Ratings, to understand, what the new RBI norms mean for the entire financial sector and whether or not it will have any kind of impact on the fintech space as well. Good morning, Sanjay. Great to have you on the show. RBI has tightened norms for consumer loans a month after flagging off the rapid growth in unsecured loans, right? So this move would lead to more expensive personal loans as lenders have to keep aside more amount of capital for the loans to recover. In fact, to cover credit risk from a particular loan segment, right? As loans get more expensive, demand is going to, of course, take a hit. Do you think this would hurt loan growth and impact profitability for lenders going forward?
Yeah, good morning, Nandita. Good morning, viewers. So this move from RBI was expected to a certain extent for some time now. RBI has been raising its concern for the growth of unsecured personal loan, and the other part is the growth of banking sector exposure to the NBFCs. So there are twin things which have been covered, because if we see over the last, let's say, 12 months or something, the unsecured personal loans and the banking sector exposure to unsecured personal loan and banking sector exposure to NBFCs has been growing at twice the rate of the other lending of the banking industry. So this move was expected for some time. In terms of the loans being expensive, we feel that it would not be too much of an impact. At a 15% capital adequacy rate and a 15% ROE, the entire impact is about 60 basis points. And the unsecured personal loan space, other than the prime space, which is largely catered to by the banks, but in the NBFCs, the range is somewhere between 14% to 36%. So we don't see that being too much impacted, but obviously there will be an impact. One is from the regulators' requirements for the banks and NBFCs to deal with the assets. And the other is the sentiments of the sector itself will get slightly hit.
Right. We'll talk about NBFCs in a bit, but what about banks? Which banks do you think will see the maximum impact of this move? Is this an opportunity for lenders with low retail exposure like HDFC Bank and Kotak Bank to race ahead of peers?
No, so we can't take specific names in our discussions, given that almost all these banks are our clients. But largely the banking sector, if we see the, let's say, the capital adequacy norm, the banking sector is pretty well capitalized. So we don't see too much of an impact on that. The impact of the banking sector probably will be 30 basis points in terms of the capital adequacy requirements. But the sector is well capitalized. So we don't see any issues out there. There may be certain slowdown in some of the banks which have a significantly high level of unsecured personal loans. The largest impact will be on the prime unsecured personal loans, because there the cost of lending would go up by at least, let's say, 35 to 40 basis points.
All right, that's the view then. But do you think the boards of many of the banks will have to reassess their growth strategies in these specific segments? The ones which do not have adequate capital buffer at the current juncture?
No, so we don't have any bank which does not have adequate capital buffer at the end. The banking industry right now is a pretty strong state of affairs. The larger impact compared to the unsecured personal loan would be on the NBFC, because that has been growing very fast, and that is somewhere the yields are also competitive. So, I think that is...
talking about NBFCs, the likes of Bajaj Finance, Chola Finance, Poonawalla, do you think the impact there will be obviously much higher, and what kind of impact do you expect there? Because Bajaj Finance has great asset quality, right? Is there any risk to asset quality going forward?
Yeah, we had a webinar recently on unsecured personal loan. So the opinion of the speakers, as well as our own in-house opinion, is that the entire sector has been tightening this, and especially since RBI has been coming out with its own, let's say, guidance for some time. So the sector has been tightening it. We have seen some amount of, let's say, increase in the delinquency, which was expected, given that there has been a significant growth in the past 2-3 years in this sector. But beyond that, we don't see any compelling sort of a credit risk as of now.
Right. Any impact on fintech players like Paytm, because they also have a certain exposure. In fact, they also give out certain, they give out loans, to certain customers, right? So any impact on fintech players like Paytm?
No, so the specific player you named largely does not carry too much of loan on its own books. They originate loans on behalf of others. So it is the people who provide the liabilities who would be more bothered about it. But as I said, many of these assets are high yield assets. So a 60 basis point probably may be a long-term impact rather than an immediate impact as such.
All right. And lastly, of course, there have been, the RBI has also tightened norms with respect to credit cards. For players like SBI card, do you think the impact will be more there, given the fact that, a company like SBI card is already troubled by declining margins and higher credit costs, right? So this would mean added burden.
So there are two parts, Nandita. One is the credit cost, and the other is the return on capital. So return on capital also depends on how much capital you have vis-a-vis the business requirements. So RBI has increased the level of capital requirements, but almost all these NBFCs and banks are carrying significantly surplus capital. What will get impacted is over the long run when the companies chart their growth path, they will see that they require more capital for certain level of businesses, which then they will try to grow lesser than what they are growing right now. So as I said, immediate impact probably would be lower, but on the long term going forward, it will be on the higher side. The other thing is the regulators have been for some time cautioning, the market itself has been cautioning that the credit quality norms need to be improved. So the discussion we had with some of the people was that, let's say in credit cards, the approval rates have declined from 30% to 20%. So there's been a significant decline in the approval rates of the credit cards, which means that the system itself has been cautious for some time now. The larger point is the growth in, let's say, the assets. The unsecured personal loan in the lending to NBFCs has been growing by more than double the rest of the sector. So to that extent, the growth certainly would be coming down a bit.
All right. Of course, there will be long-term impact of the RBI move. But with that, Sanjay, thanks a lot for taking out time and sharing your thoughts with us this morning. It was a pleasure chatting with you.
Thank you very much.